A market irrationality refers to the phenomenon where investor behavior deviates from rationality and efficient market assumptions, leading to distorted asset prices, misallocations of capital, and inefficiencies in financial markets. It reflects the influence of emotions, cognitive biases, and psychological factors on market participants' decisions and actions, often resulting in market anomalies, bubbles, crashes, and inefficiencies. Here's a detailed explanation of market irrationality. Traditional finance theory assumes that market participants are rational, utility-maximizing agents who make decisions based on all available information and in their best interests. However, behavioral finance challenges this assumption, recognizing that investors often exhibit irrational behavior, emotions, and cognitive biases that influence decision-making. Market irrationality manifests in various forms, including overreaction, underreaction, herding behavior, anchoring, confirmation bias, availability bias, loss aversion, and representativeness heuristic, which lead to systematic errors in judgment and suboptimal investment outcomes. Overreaction and underreaction. Overreaction occurs when investors overvalue positive news or information, leading to excessive buying and inflated asset prices. Underreaction occurs when investors underreact to new information, leading to delayed adjustments in asset prices and mispricing opportunities. Herding behavior. Herding behavior describes the tendency of investors to follow the actions and behaviors of the crowd without independent thought or analysis, leading to momentum trading, amplification of market trends, and market bubbles. Anchoring and confirmation bias. Anchoring bias occurs when investors fixate on specific reference points or past prices when making investment decisions, while confirmation bias leads investors to seek out information that confirms their pre-existing beliefs or opinions, ignoring contradictory evidence. Availability bias. Availability bias occurs when investors overweight recent or easily recalled information, events, or experiences when making decisions, leading to an overestimation of the probability and impact of certain outcomes. Loss aversion. Loss aversion refers to the tendency of investors to prioritize avoiding losses over achieving gains, leading to risk-averse behavior, reluctance to sell losing positions, and suboptimal portfolio management. Representativeness. Representativeness heuristic occurs when investors make decisions based on past patterns, analogies, or stereotypes, rather than considering all relevant information or probabilities, leading to erroneous judgments and mispricing of assets. A market irrationality gives rise to various market anomalies and inefficiencies, such as price bubbles, speculative manias, market crashes, underpriced or overpriced assets, and mispricing of risk, which deviate from fundamental valuations and efficient market principles. Examples of market anomalies include the dot-com bubble in the late 1990s, the housing bubble and subprime mortgage crisis in the mid-2000s, and the Bitcoin bubble in 2017, where investor irrationality and speculative excesses led to inflated asset prices and subsequent market corrections. Understanding behavioral biases and market irrationality is essential for investors to recognize and mitigate the impact of cognitive biases on their investment decisions, avoid common pitfalls, and make more informed and rational investment choices. Contrarian investors seek to exploit market irrationality by taking positions opposite to prevailing sentiment, buying undervalued assets during periods of pessimism, and selling overvalued assets during periods of optimism, aiming to capitalize on market inefficiencies and mean reversion. Effective risk management involves identifying and managing behavioral biases that can lead to suboptimal investment outcomes, implementing disciplined investment processes, diversification strategies, and risk mitigation techniques to protect against the impact of market irrationality and unexpected events.